Current market price for Inno Holdings Inc., NASDAQ INHD, is hovering right at 0.705 USD, showing a decline of approximately 3.93% for the intraday session so far. But that single red percentage point is deceptively calm. It hides one of the most violent whipsaw trading sessions we have seen in the microcap space this month. If you are just looking at that closing red number, you are missing the entire story. Earlier today, in the pre-market hours, this stock wasn't down 3%, it was up over 20%, gapping aggressively higher on news that has completely confused, excited, and perhaps terrified the existing shareholder base. We are seeing volumes today that are simply astronomical compared to the historical average. Over 240 million shares have changed hands. To put that in perspective, this is a company that usually trades a fraction of that. The liquidity floodgates have opened and the volatility is off the charts. This brings us directly to the central tension of this stock, the massive disconnect between expectation and reality. The expectation. Most investors looking at Inno Holdings see a small, struggling industrial play. They see a company based in Brookshire, Texas, that bends steel. The expectation is that this is a construction material stock, tied heavily to housing starts, interest rates, and the boring, dusty world of cold-formed steel framing. You expect their stock price to move in lockstep with lumber prices or home builder sentiment. You expect a slow, grinding business model that requires heavy machinery and low margins. The reality? As of this morning, Inno Holdings is effectively trying to rebrand itself as a high-tech, Web3-powered logistics operator. The reality is that this steel company has just announced a partnership with a firm called Megabyte Solutions to integrate blockchain technology into a B2B marketplace. You are not trading a steel vendor anymore. You are trading a highly speculative, dual-natured entity that is half industrial manufacturer and half crypto-adjacent tech startup. The reality is that the market has no idea how to value this pivot. Is it a desperate attempt to catch a hype wave or a genius stroke to modernize the supply chain? The 240 million shares traded today tell you that the market is furiously trying to decide, and that indecision is where your opportunity and your danger lies. Let's break down this intraday action because it is critical for anyone holding or watching INHD right now. The stock opened significantly higher, pushing towards $0.94 and even touching highs above that in the pre-market liquidity vacuum. This was a classic gap and crap setup for many day traders. The news hit, the algorithms read Web3 and partnership, and the buy orders flooded in before the bell. However, as the regular session opened and the reality of the heavy outstanding share count set in, gravity took over. We saw a consistent fade from those morning highs, a pattern that suggests heavy profit-taking by trapped longs who have been holding this bag for months. The stock falling back to the 0.70 level indicates that the initial euphoria has burned off and we are now left with the hard work of price discovery. If you bought at the open, you are underwater. If you bought yesterday, you are likely scratching your head wondering if you should have sold the spike. This massive volume is not just retail noise. When you see turnover exceeding the entire float of the company multiple times over in a single session, it means the shareholder base has completely rotated. The people owning INHD at 9 a.m. are not the same people owning it at 3 p.m. This is a churn event. It resets the technical support and resistance levels entirely. The old resistance at $0.80 is now a bag holder line. The new support at $0.68 is the line in the sand for the bulls. Now let's step back and look at the catalyst that caused this firestorm. The company announced a non-binding Memorandum of Understanding, MUU, with Megabyte Solutions Limited. The goal? To develop Web3 technology applications for a cross-border B2B marketplace. Comment below if you think a steel company pivoting to Web3 is a brilliant diversification or a red flag. Do you trust industrial companies when they start using tech buzzwords? I want to hear your take. This announcement is fascinating because it attacks the expectation we talked about. Inno Holdings has historically been about physical atoms. They take coils of steel and turn them into studs, tracks, and framing for buildings. Now they are talking about digital bits. The partnership aims to use blockchain to handle logistics, supply chain management, and transaction privacy. On paper, this sounds incredible. Supply chains are messy. Cross-border trade is rife with paperwork errors and delays. A decentralized ledger, blockchain, could theoretically solve this. But here is the contrarian take you need to consider. Why now? Inno Holdings has been burning cash. Its stock has been battered down significantly over the last year. A sudden pivot to Web3 often signals a management team that is looking for a narrative shift to boost the stock price rather than a core operational improvement. We saw this during the dot-com bubble, we saw it during the crypto boom of 2017, and we are seeing it again. When a company that makes caster cubes and metal studs starts talking about decentralized service models, you have to be extremely skeptical. The expectation is that this news drives growth. The reality might be that it's a distraction from a core business that is struggling to scale profitably. But we cannot dismiss the core business entirely because that's where the tangible assets are. Let's talk about what Inno Holdings actually does when they aren't signing Web3 MOUs. This is important because if the tech pivot fails, this is the floor you're standing on. Inno Holdings operates in the off-site construction, OSC sector. This is a legitimate growing industry. The traditional way of building houses, cutting wood on site, dealing with weather delays, managing waste, is inefficient. Inno's solution is cold-formed steel. They use intelligent machines to roll steel coils into precise framing members. Steel is superior to wood in many ways. It doesn't rot, termites don't eat it, it's fire-resistant, and it's straighter. But Inno goes a step further with their mobile factory technology. This is actually quite cool, and arguably their real moat. Instead of shipping huge air-filled wall panels across the country, which is expensive, you are basically paying to ship air, Inno puts the production machine inside a shipping container or a trailer. They tow this mobile factory directly to the construction site. It has its own diesel generator, its own software, and its own raw material coils. They park it at the job site and the machine spits out custom-cut steel framing studs right where they are needed. It's like bringing the factory to the field. They claim this reduces transportation costs by a massive margin and cuts down the carbon footprint. They also have a proprietary IoT system called the Genie or something internal dashboard that allows them to monitor these remote mobile factories from their headquarters. They can see uptime, production rates, and maintenance needs in real time. This is the industrial tech part of their identity that actually makes sense. It solves a real problem, logistics costs, with a real solution, mobile manufacturing. Then there are the caster cubes. These are modular, prefabricated units that Inno manufactures. Think of them as Lego blocks for construction. They're designed to be quickly assembled into accessory dwelling units, ADUs, small offices, or emergency housing. This fits into the broader trend of modular construction, which is gaining traction as housing affordability becomes a crisis in the U.S. If Inno can scale the sales of these physical units, that is real revenue, that is real cash flow. So we have a company with a genuinely innovative physical product, mobile factories, that is currently being overshadowed by a flashy, intangible announcement, Web3 marketplace. This creates a schizophrenia in the stock's personality. Are you buying the steel bender or the crypto exchange? Let's look at the financials and the recent stock movement in a macro context. Before today's volume explosion, Inno Holdings was suffering from a severe lack of liquidity. The stock would drift for days with minimal interest. The recent capital raise, a registered direct offering of about $7.2 million, was a double-edged sword. On one hand, it gave them a cash runway. Small caps like this die when they run out of cash, and Inno was running low. The $7.2 million allows them to keep the lights on, build more mobile factories, and perhaps fund this new Web3 experiment. However, these raises are dilutive. They increase the supply of shares, which makes it harder for the stock price to sustain upward momentum. Every time the stock pops, there are now more shares available to be sold by institutional holders who participated in that offering. We also have to talk about the sector momentum. The industrial and building material sectors have been mixed. High interest rates have put a damper on new residential construction projects, which is Inno's bread and butter. If builders aren't building, they don't need steel studs. But the infrastructure spend from the government provides a tailwind. If Inno can position its mobile factories for infrastructure projects, say temporary housing for bridge builders or remote facilities, they could bypass the residential slowdown. But the market today isn't trading on infrastructure bills. It's trading on retail sentiment and momentum. The chatter on platforms like Robinhood and message boards is entirely focused on the partnership news. This is dangerous. Momentum traders are fickle. They are here for the volatility, not the vision. Once the volume dries up, and it always does, the stock will have to stand on its fundamentals again. And what are those fundamentals? They are tough. The company is not yet profitable. They have a high burn rate. Their revenue, while